Before the Federal Reserve, the United States didn't have a true central bank. There was no single institution responsible for stabilizing credit, no official lender of last resort, and no unified system to inject liquidity when the country panicked. America had banks, it had money, it had markets, but it did not have a central nervous system. So whenever fear spread, the financial system didn't bend, it snapped. In the late 1800s and early 1900s, financial panics weren't rare events, they were a recurring feature, and the pattern was always similar. Confidence broke, depositors rushed for cash, banks protected themselves, credit froze, not because the country ran out of wealth, but because the system ran out of trust. To understand why, you need one simple detail about that era. Bank deposits were promises, and promises only work as long as people believe everyone else will keep believing too. The moment that belief fades, people don't calmly reevaluate. They run, and when enough people run at once, even healthy institutions can fail. Now add another problem. The U.S. money supply back then didn't expand smoothly when the economy needed it. It expanded and contracted in waves, seasonal waves. Every fall, for example, the demand for cash would spike. Harvest season, payrolls, shipping, commodity settlement. Cash moved out of financial centers and into the real economy. That meant the system could become tighter, not because anything was wrong, but because it was simply the wrong month. So it didn't take a huge shock to start a chain reaction. It took a spark. That spark arrived in 1907. What happened is often called the Panic of 1907, but what it really revealed was something deeper. America's financial structure was modern enough to create enormous wealth, but not modern enough to survive fear. In October 1907, a series of failed financial moves triggered a crisis of confidence. The headlines at the time weren't about inflation or unemployment. They were about institutions people trusted suddenly looking fragile, and one name became central: Knickerbocker Trust Company. In that era, trust companies weren't exactly banks, but they behaved like banks in practice. They took deposits, they invested, they provided credit, and they often operated with looser rules than national banks, which meant higher risk, less transparency, more vulnerability when confidence turned. When Knickerbocker came under pressure, depositors lined up, withdrawals accelerated, and once that run began, it didn't stay contained, because panic is contagious. If one big institution looks unsafe, people ask the same question everywhere else: is mine next? Then the system did what systems do when survival is threatened. It pulled inward, banks stopped lending, institutions hoarded cash, the stock market fell, and businesses, suddenly unable to borrow, began to suffocate. This is the moment most people miss. A financial panic is not only about banks, it's about the real economy losing oxygen. Credit is oxygen, and when credit stops, everything slows, fast. So, where was the government? Here's the key. There wasn't a central mechanism to respond, no official institution that could flood the system with liquidity and calm the panic. The country had power, it had money, but it didn't have a switchboard. So the response came from somewhere else, a private individual, J.P. Morgan. Morgan was already the most influential financier in America, and in 1907 he effectively became the emergency manager of the national financial system, not because anyone voted for him, but because there was no alternative. He gathered the leaders of major banks and institutions, he demanded numbers, he demanded commitments, and he orchestrated a rescue plan. Some institutions were supported, others were allowed to fail. And the entire country watched a reality unfold that would be impossible to unsee. In a national crisis, the system needed a central bank, but it didn't have one, so it improvised one, in the living room of a private banker. That moment became a turning point, because it created a political question with no comfortable answer. Should the stability of the U.S. economy depend on the personal decisions of a single private financier, during a panic, behind closed doors? Or should the country build a formal institution designed for exactly that job? After the Panic of 1907, Washington did not treat this like a one-off accident. They treated it like a structural failure, a system failure, and the goal became clear: build a mechanism that could do three things. 1. Provide liquidity in a panic. 2. Reduce the violent cycle of credit booms and freezes. 3. Create a more elastic currency supply, so the economy wouldn't choke every time demand for cash jumped. So Congress passed emergency reforms, not the final solution, but a bridge, a temporary tool to stabilize the system if another panic hit, before the country designed something permanent. This is how big institutions are usually born. First, a crisis exposes the weakness, then a temporary fix buys time, then a permanent structure gets built, and it gets built by people who understand the weakness intimately: bankers, politicians, economists, power and design, in the same room. Because the truth was unavoidable. America had grown into an industrial giant, a global economic force, but its financial architecture was still patchwork, too fragmented, too dependent on private coordination, too vulnerable to fear. And that brings us to the next step. Not a public conference, not a televised debate, a quiet closed meeting, a small group, a remote location, a plan, the meeting on Jekyll Island, and what came out of it would reshape money forever.